Welcome to the Introduction to Billing and Accounting. This course is designed to introduce some important information you need to run your business successfully. Most law schools teach law and not business. If you are running a law firm, you are running a business. Being a great lawyer and marketer is not enough to be successful. You need an understanding of business and accounting basics. My name is Karen Schwartz. I am an associate of 3545 Consulting Global and the founder of Time and Sense Consultants. I have a bachelor's degree from Colby College and an MBA from the Johnson School at Cornell University. Our business is helping firms manage time, money, and information. Our goal is to help you find the tools and processes that will work best for you and assist you in getting the software that will best meet your needs. We are a team of consultants certified on billing, accounting, and practice management software programs. We are also certified on Microsoft products and work with hardware. While I am certified on TimeSlips, QuickBooks, PC Law, Time Matters, and Amicus Attorney, we have team members certified on Practice Master, Tabs 3, WorldDocs, online products, and Mac products. We help you make your software work for you and your firm through training and customization. Today's topic, the first in this series, is an introduction to accounting. Other sessions will cover billing basics, billing concepts beyond the basics, billing and accounting options, and the all-important getting paid. Just participating in this webinar shows you probably realize that there's more to running a firm than just practicing law. I can't give you the citation for this statistic, but I know that a common complaint among my clients is, I just want to practice law. Whether or not the number is precise, it's an issue. My goal is to help you find ways to reduce the administrative headaches so that you are not part of the statistic. The old adage, people don't plan to fail, they fail to plan, holds true for small businesses of all types. The failure rate for new businesses is around 70 to 80% in the first year, and only about half of those who survive the first year will remain in business the next 5 years. Financial planning for your business is a big part of the planning you need, and understanding those financials is critical. According to Dun & Bradstreet, 88.7% of all business failures are due to management mistakes such as these. I don't need to read them to you, but I will give you a moment to look at this first part of the list. Among the 12 leading mistakes that lead to business failures are lack of financial responsibility and awareness. This course will not teach you accounting, but it will give you an understanding of the basic concepts so that you can be aware financially. While there are no magic solutions to guarantee business success, there are things you can do to assist in improving your chances. Creating a business plan requires financial assessments and predictions and should lead to ongoing measurement against your plan. While you may involve your accountant and financial team in creation of the business plan, you ultimately have responsibility for the numbers. You can also improve your chances for the success of your firm by having the ability to obtain accurate financial information about the business in a timely manner. You can do this by creating your financial reports or making sure they are created properly, and by understanding the basics of financial management. Knowing your financials can help you understand your pricing as well. This lets you know if you can reduce your rates without hurting your business. While there may be good reasons to lower your rates, you should never get in the habit of lowering your rate just to compete. Someone else will almost always have a lower rate. Therefore, competing on rates actually reduces your chances of success. When you set up your firm, there are a lot of things to do that don't involve practicing law. You may rent office space, purchase furniture and computers, set up a phone system, buy business cards and supplies, get a research subscription, and begin advertising. You also need to set up bank accounts, track your income and expenses, pay taxes, and lots more non-law stuff. You will probably hire an accountant to help with this. Accountants talk a different language and will likely ask you questions that you don't necessarily know how to answer. They might ask, what accounting method do you want to use, or start talking about assets and liabilities. If you need a loan, the bankers or investors will probably ask about a balance sheet and income statement. We are going to try to take the mystery out of these terms. We will begin by discussing the two types of bank accounts. We will then discuss what is meant by accounting methods and how to choose. Finally, we will discuss the terms you are likely to hear from your accountant, banker, and investors, and help you understand what they mean. I'm sure everyone is familiar with savings accounts and checking accounts, but for law firms there are two types of checking accounts you will probably need: an IOLTA or trust account and an operating account. The operating account is your firm's money. This is money that you can spend however best suits the needs of the firm. If you collect money from your clients before you earn it, the funds are generally kept in either an IOLTA account or a trust account. Separation of these two accounts from your personal accounts is critical, as bar associations have strict rules regarding keeping clients' money separate from your funds. Depending on the nature of your practice, you may need an IOLTA account and multiple trust accounts. If you operate in more than one state, you will likely need separate IOLTA accounts for each state. Precise rules for handling of trust and IOLTA accounts vary by state, so please check your bar association rules. While the limits and rules may differ, the concept is the same. Trust and IOLTA accounts differ based on to whom the interests belong. Client funds that you are holding are deposited into an IOLTA account when the funds will not earn enough interest to cover the cost of separating those funds. The interest earned on the IOLTA account is used to pay legal fees for those in need. The bank will generally deposit interest and immediately remove it and forward it to the appropriate state organization. You must be certain that your bank is certified as eligible to hold IOLTA funds. Large amounts, or amounts that will be held for long periods and therefore will earn significant interest, are put into a trust account with the interest belonging to the client. It is important that you keep accurate records of your client's money and properly track any movement between the IOLTA account and your operating account, as well as any trust account interest. Most bar associations require double or triple reconciliation of the IOLTA and trust account balances and the amounts belonging to each client. So whatever method you use for tracking the client funds, you must make sure that you track the amount belonging to each client and that the total equals the amount in the actual bank account. Here's a shocking secret. Most people find accounting boring. However, it is important to your success. My goal is to help you understand basic accounting concepts and words so accounting is less confusing and hopefully a little less boring. We can start by talking about why do we need accounting. We have to file tax returns to keep the Internal Revenue Service and the State Revenue Department happy. The government wants to know how much you made after expenses so that they can collect the correct taxes. Of course, you want to make sure you pay the correct taxes and don't give the government more than they are owed. The governments also want to know how much you are paying employees so that they can collect the appropriate employment taxes and the taxes from your employees. They also want to make sure you are following tax laws. If we need to borrow money, accounting is the tool used to show investors or the bank that we are a good investment. And of course, accounting helps us to know how much money we have available. What can we afford? If it's macaroni and cheese, accounting can help us determine what we need to do to afford steak, lobster, or something similar if you're a vegetarian. When setting up accounting software, one of the first questions asked is, what accounting method does your firm use? Even if your firm will not use software for your accounting, this is something you should decide early on, as changing methods can be difficult. Accounting methods refer to how you recognize income and expenses. The choices are cash, modified cash, or accrual. In some software systems that are not designed for law firms, you may only see cash and accrual as choices. The Internal Revenue Service requires you to choose an accounting method and stick to it. The method you choose can impact your taxes as well as how much you seem to be making. Most law firms in the United States report income and expenses on a cash or modified cash basis. If your software does not have a modified cash option, you can still set up the system that way. It's just something you do yourself. Cash basis means that when you send out invoices to clients, you don't have income from an accounting or tax perspective. It's only considered income when you actually collect money from your clients or transfer the money from the IOLTA or trust account to your bank account. Similarly, when a vendor asks you for money by giving you a bill, that is not considered an expense from an accounting or tax perspective on a cash basis. There is nothing recognized as an expense until you pay the vendor by cash, check, or credit card. Modified cash is a slight variation on cash basis related to the treatment of expenses paid on behalf of clients. If you have a lot of reimbursed client expenses, using modified cash may be required by the government and can reduce yearly swings in income due to the timing of reimbursements by clients. With modified cash accounting, reimbursed client expenses do not impact your profit and loss. They are designated on the balance sheet. Accrual accounting involves accounts receivable, accounts payable, and potentially bad debt if you find you have to write off invoices. With accrual accounting, the invoices you have sent to clients are considered income even before you are paid, and the bills received from vendors are immediately considered expenses for tax and accounting purposes. You can see how you might significantly impact income and taxes on an accrual basis by paying all your bills on December 31st and waiting until January 1st to send out your invoices. Although over time the flows will probably even out, it can have an impact, so you want to think about which method will be best for your business. You should be aware that it may be possible to file your tax return on a different basis than your internal reporting. You should discuss your decision with your accountant. However, I find that modified cash is generally preferred as it gives the most accurate view of your business. We've already mentioned that accountants generally speak a different language than attorneys. While you don't have to understand everything, there is benefit to being able to speak their language. Since the language of the accountant is used by bankers and investors as well, it's important that you have a basic understanding. When speaking with an accountant, you may hear some of these terms: All of these are related to the financial management of your firm. Understanding these terms can help you speak to your bank and your accountant. Most importantly, the information related to these terms can help you make smart financial decisions. Financial management is the process of running your business and understanding your business. You don't have to understand all the details of preparing your tax return, but you will save time, money, and aggravation if you understand how to properly record the money you receive and the money you spend. Additionally, you can make more accurate and timely decisions if you personally understand how your business is doing. Financial management can help you to succeed in 6 ways. First, financial management lets you identify your cash flow, where money is coming in from and where it's going out to. Knowing the flow of cash offers you the opportunity to make adjustments in a timely manner. Many businesses go out of business not due to lack of customers, but due to lack of cash. If all your clients take 90 days to pay, but your vendors expect payments in 30 days, you could have an issue with cash flow. Addressing this type of issue early can help you stay in business. Financial management can help you understand your customers. Knowing your most valuable clients can help you direct your marketing efforts as well as your workflow. Value can be measured not only by the amount of work and the profitability of the work, but also by referrals and promptness of payment. A client that pays promptly and refers you to others is far more valuable than a customer you have to chase after in order to get paid. Don't forget to also look at the type of work you are doing for your customers to help you understand your market. Knowing where you are spending money can help you obtain discounts from vendors and find other ways to save money. It can also help you to negotiate better terms. I know of a business that saved hundreds of dollars by obtaining an American Express card, primarily for the purpose of paying their Federal Express bills. American Express gives a rebate on Federal Express charges, and this business did a lot of spending on Federal Express. The cost of the American Express card was more than covered by the rebates. Without good financial review, this opportunity might have been missed. The ability to obtain credit from vendors is also essential to your business. If you can wait longer to pay vendors, that will help your cash flow and may give you more flexibility in other areas. You will also have more leverage with a vendor that you spend a lot of money with than one that you only use for very small jobs very rarely. We talked earlier about the importance of compliance with state, federal, and local government tax organizations. If your records are good, this process is easy and far less expensive than if the accountant has to dig through boxes of papers to obtain the correct information. Several years ago, I went through an audit. My accountant called me one day and said the IRS wanted to do the audit the next day. The accountant didn't have the detail for all my numbers, but I did. I was able to take 10 minutes and provide the information they needed. They met with the auditor, and the result was no change to my tax liability. My ability to provide the detail quickly saved time and money. The auditor was satisfied, and because we responded quickly, he had no excuse to delay things or look further. Additionally, reports from your financial management system can help you make good decisions in a timely manner. If you are thinking about hiring someone new or buying new equipment, knowing your overall financial business position can help you make the right decision. Want to take a vacation? Financial reports can tell you how much money is available for you to take out of the business without hurting your business's ability to grow and prosper. If you need to borrow money, the bank or investors will require financial statements. As discussed earlier, even vendors that offer you time to pay them, commonly known as terms, want to know that you can pay them back. If it takes you a long time to provide the information, it could cost you more, not only because the interest rate may rise. Without good financials, you may be considered a higher risk, or you may not be able to get the capital in the time you want it, and that delay could have a negative impact on other areas of your firm. So now that you know what financial management can do and why it's important, what do you actually need to know, and how does this translate to the accountant? Let's look at the terms the accountant uses. Think of the column on the right as the accountant's terms and the column on the left as your translation. When the accountant asks about sales, they are simply asking, how much money did you bring in? Expenses are asking, how much are you spending? The difference between sales and expenses is how much money you are making. Hopefully it's positive. It's important to realize that how much you are making and cash are not the same thing, as there can be other factors besides sales and expenses. These are represented by assets, liabilities, and equity. We'll be looking at financial statements in a moment, but sales and expenses show up on your income or profit and loss statement. Assets, liabilities, and equity are grouped together on the balance sheet. One place that cash may be used is to buy things for the firm, commonly known as assets. If the asset is cash or is expected to be turned into cash in less than 12 months, it is considered a current asset. Fixed assets can be viewed as those things you own that you can touch or feel, like a car, a desk, or a computer. These may have some special treatment in the preparation of your taxes. You can also use cash to reduce what you owe to others, your liabilities, or you might increase your liabilities by borrowing money so that you can increase your assets. Anything you owe that you expect to pay in less than 12 months is considered a current liability. Those debts that are expected to take longer than 12 months to pay are considered long-term liabilities. The third section of the balance sheet is the equity section. The money you and your partners invest in the firm directly is a type of equity known as owner's investment or capital. Another type of equity is retained earnings. This is the income the firm earns that is left in the firm rather than taken out in the form of dividends or payments to you, the owner. These items make up the balance sheet. At the most basic level, there are two key measurements used by accountants and investors. These are the income statement and the balance sheet. The balance sheet shows what the firm owns and what the firm owes as of a date in time. It is called a balance sheet since it must balance. The assets, what you own, must be equal to the total of what you owe to others and what you have invested in the firm. A balance sheet that doesn't balance is just a sheet and not a useful financial tool. The income statement is also commonly called a profit and loss or P&L. It is a summary of the revenue and expenses of the firm over a period of time. The bottom line on the P&L is the firm's net income or net loss. This is what becomes retained earnings. Here is a sample, very simple profit and loss statement and balance sheet. On the profit and loss or income statement, the total income minus expenses is equal to the net income. On the balance sheet, the total assets are equal to the total liabilities plus the total equity. The net income for the current period, as reflected on the profit and loss statement, shows under equity on the balance sheet. The retained earnings on the balance sheet is the sum of the net income or losses for prior years. On January 1st, before any new income or expenses are recorded, the retained earnings will be increased by the amount of the net income, and the net income for the new year will become zero. In summary, a law firm is a business. Understanding the numbers can help you keep your business making money and help you know what you can afford to pay yourself. If there are problems, you can determine where those problems are. Problems may be caused by management issues, or unfortunately, they might be caused by theft or incompetence. You need to take a look at the numbers to find out where the problems lie and to determine what action to take. Talk to your accountant and ask them to help you understand. You can compare your numbers to those of similar sized firms in your area to get an idea if your numbers are in line with normal. Just like your clients need to be able to talk to you, if you can't talk to your accountant, you may need to find a different accountant. As a law firm, your business rates in the top of those businesses with the best rate of success after the first year. You can improve your chances by good financial management. This starts with you understanding the terms and concepts of financial management. From here, you should look to better understand what the numbers mean and how your numbers compare to others in your profession. Thank you for joining me for part 1 of an introduction to billing and accounting. Our next session will be designed to help you with the income side of the business, how to create successful bills. Following that, we will discuss different billing options that you may deal with, either by choice or because of client demand. Options that you can use to make billing and accounting easier and less time-consuming, and tips on how to get paid faster.